Okay, it's October 7th, Friday, and again, markets at a critical place, as I've been warning recently. The really good and clear news is we have seen a top, okay? You never know you've seen a top until the markets correct enough and bounce weakly enough, as we've seen here. You never know that till it happens. So what that says is the first wave down, which we've seen, is harder to see in advance. The easier wave to catch is the third wave down, the next wave down in between before the final fifth. But that middle wave tends to be the strongest on average and the easiest to see. So we have had this correction into mid-June. We had a bounce into August. We've come back down to those correction lows. We're testing those. And the only question here to me, do we go back up and retest those rebound highs, just the bounce highs, before we go down strongly in this third wave, or are we already in it about to break out? So that's the real question here. Obviously, I'll keep giving updates. But again, it's important to understand the reason we know this is a high now is we're in a position now where the Fed is actively tightening. They are tightening out of their own overreaction, as I've said a million times earlier. They overreacted to COVID, forced them to tighten the most aggressively they have, really, in decades, okay, or ever. So while they're doing this, there is no way the market's gonna make a new high, okay? So we are in this greater crash. We've seen the first wave down. We're in the second wave bounce and may have completed that or not. If not, we will soon. And then the nice, great third wave will come. So this is the best period in here. If you haven't sold or you sold half, to sell on this bounce, certainly before we break down below this. And if we get a little bounce, it will be the optimum time. And if you're aggressive and want to make money short, this is the best wave to catch, the two-wave top near there into the three-wave decline down, because the fifth wave tends to be slower and take longer to play out, and that could be good too later. But right now, this is probably the most opportune point for investors in the crash of a lifetime. And of course, the other key factor here, we got the treasury bonds. They are our safe haven. They are the thing that could double. ZRAs, which is a leverage play on TLT, goes up about 1.5 to 1.6 times as much because it's 25-year duration instead of 20, okay? ZRAs, by my projections, could double or a bit more during this crash. TLT could be up 70, 80% or more. It's rare that you can make this type of money in the safest investment on earth. But these bonds are still retesting their lows. So 101, we hit the bottom of kind of the megaphone channel, which we had to redraw a little bit, but works fine. But we're retesting that already here. So this is a critical point. We need to hold near 101 in TLT. It's going like 100.85 this morning or something on the open. So that's close enough. But if that thing starts dropping much more, then we may have to see rates go higher, because again, the jobs numbers came out this morning and they were as expected, but still pretty strong. So that leans towards, inflation's not going to go away too fast here, and that means the Fed's going to have to keep tightening longer. So that's what the markets are reacting to today. And again, we're just going to have to watch this. We're at this critical point, and it's important to play this properly. And stocks short will do better in the earlier stages, something I'm going to discuss next week in my updates and stuff and Harry's take. The stocks will go down faster in the first half of a downturn, and the bonds will respond more at the safe haven rising in the second half. So we're kind of in that zone. This wave down in stocks will still be better to be short stocks rather than long bonds, although both is a great portfolio play. But boy, once this third wave is down, we really want to lean into being pretty much 80 or 100% long TLT, ZRAs, and the 30-year treasury bonds. Keep you updated.